We're going to cover a lot of revolutionary concepts in this course. And so one of the challenges is where to begin, because all of these concepts are interrelated. So what I'm going to start with here is an overview and go through everything just at a high level so we can understand sort of the overall landscape. And then from there, I'll move into each one of these things in much more detail. And even before I start these in more detail, what I'm going to do is give us a background, a history about money, banking, the economy, basically to understand how we got here, where we came from and how we got here. So think of cryptocurrencies, blockchain, decentralized finance, non-fungible tokens, all these different concepts. Think of them as the internet of money, because that's basically what's happening, is it's the internet of money. These concepts all together streamline money and transactions think of it like email did for sending a letter. That type of revolutionary advance. I mean, now we just send an email really quick. They get it on the other side. They respond. It used to be you have to write a letter, put it in the mail. A week later you might get a response. So the velocity of information exchange and transactions has really picked up because of that. Well, this is what this represents for the concept of money. So what is money? Right? What does money really mean? What does it do? Well, it's a medium of exchange, right? That's our transactions. You order a sandwich, you give the guy $5, he gives you the sandwich, over the deli counter. Those all transactions are done that way. It's also a store of value, right? Like we use gold as a store of value. So money can be a store of value. And also it's a unit of account, and that's a little more abstract maybe. A unit of account meaning that it accounts for, it's a record of those transactions that we do, the exchanges, right? Basically that's accounting, and if you want to know more about accounting, take my accounting course on here, and that'll tell you about that. But basically accounting and debits and credits in accounting create a ledger. And basically what the blockchain is a decentralized ledger. And we'll get into that in more detail. But these are the three aspects of money, what money really is, right? Medium of exchange, store of value, and a unit of account. So cryptocurrencies can basically be divided into several broad categories, right? There's Bitcoin. That was the first one. That was invented in 2009, basically came out of a paper. Really fascinating. A white paper in 2008 when the financial meltdown happened, the financial crisis happened. This was a paper that said, here's a way for us to rethink money in a decentralized manner that wouldn't have those kind of risks that made the whole system cascade and topple down as it did in 2008, or as it did in the Great Depression in the 1930s, right? So there's Bitcoin, there's Ethereum, which took Bitcoin a little further and made it actually into a programmable, like a giant computer, basically took the blockchain and to its logical extensions. And then there's altcoins, which are sort of derivatives of the Ethereum protocol and Ethereum concept. So we'll talk about all these so you'll really understand what they are, the different layers of them and everything. So that's coming up. So what is a blockchain? A blockchain is, think of it as a layer riding on top of the internet, just like the web rides on top of the internet with all the images and interactions we can do with web pages and browsers. Blockchain is similar to that, where it rides on top of it, and it basically could not happen without the internet and without computers, and it's a distributed ledger. And what I mean by that is that a blockchain is a sequential log of events or data that are tamper-proof. You can't mess with them after they get into the blockchain. And it's transparent. Anyone can look at all the transactions that have happened, which is really amazing because it's transparent, yet you can't tamper with it. You can't mess with it. It's really secure. And it's secure because these things are done by cryptography. So the blockchain is secured by cryptography, And cryptography is basically the idea of communication in the presence of adversaries. It's basically how we make secret codes and things. So you can have you encrypt it on one end, you send it, and then they decrypt it on the other, and anybody can't read the message or mess with the message in between. That's what cryptography does. So blockchain is based on concepts of the internet and concepts of computers, and the tamper-proof part, the secure part, is from cryptography. So DeFi is a term you'll see thrown around all the time. It stands for decentralized finance, and that's in opposition to centralized finance. What is centralized finance? That's banks and credit card companies and other things that where all the transactions have to go through that toll booth in order to happen, and they take a big fee for that. And what DeFi does is it addresses a number of the structural risks inherent in the fragility of the financial system as it is now. That there's a lot of people taking on a lot of risk in the system that then we as taxpayers have to pay for when these too big to fail banks eventually fail and all. And the danger that we might go into some type of recession or depression that will cost us all our jobs and things like that. So that's what DeFi is there to address. And we'll talk in great detail about that and what finance is, how finance works. So what is finance, basically? Finance is the moving of money and risk through a network. And in this case, the network is the economy. And that's what commercial banks, investment banks, credit card companies, that's what they do, right? They move money and risk through the system. And when I say risk, insurance companies are transfer of risk, right? There's a risk that your house may burn down, or you may get in an accident with your car, and you pay the insurance company to bear that risk so that it does happen. They've pooled all that money, and then they can use stochastic equations to figure out how much they should charge to cover that risk. And then if your house does burn down, they pay for it, right? And so that's something that's what risk. That's what I mean by transfer of risk. Transfer of money, we all know what that is, right? You pay with your credit card, or you pay with through your bank or something like that, and then with a check or with money, right? And then they do the transaction, and they're keeping this ledger, right? They're keeping the debits and credits, how much money you paid out and how much money you have coming in. So the other thing is with all these systems, we're already familiar with digital money, right? That concept is not new to us. It would have been 50 years ago, right? Everybody used coins, and they used dollar bills and stuff to make your transactions, right? Or to save, right? You would save that way as well. That would be your store of value. And so everybody had coins, currency, coins, and paper money. And that was the way that we did the transactions. Nowadays, I rarely carry cash, and I'm sure you don't either. We use our credit card or something. You go in the store, you give somebody your credit card, and what's the secure part that they put on there now is they put the little chip in the card where you have to stick the chip in, right? And now we have Apple Pay. We have all different kinds of pays that are still based on fiat currencies, monies that are created by governments, but that's the difference. But we're really familiar with the system of just magically digital money going around, and it's all just ones and zeros and computers transferring from one account to another. So that concept is not unfamiliar to us, which is a big conceptual leap that we've already taken in this type of process. So NFTs, you've probably heard about those, non-fungible tokens. What the heck does that mean, right? We'll talk about that. But NFTs, people are making different little logos, icons, or artworks, and they're selling for tons of money. There's OpenSea and these other exchanges where people are buying NFTs. And the key concept behind NFTs is that non-fungible tokens that we've been able to create property rights in the internet, digital property rights. So now we can own property in the internet. So somebody makes a song, it doesn't just go out and everybody can listen to it anymore. That artist can own that song, and then every time anybody listens to it, they get paid a little bit. So artists or books or writers or artists that create a painting or a visual artwork, they can own that artwork, and even as that gets sold in the future, they can get a portion of those fees. So that idea of digital property rights is revolutionary and really helps to make the internet into a whole new world for people, creatives, to make a profitable living online, which is really, really incredible. Web3, you might have heard of that. That's a new concept being bantered around, where we had Web 1. Basically, once the internet was built, we had the web, World Wide Web was put on top of that. Tim Berners-Lee was the guy who invented it. And we had browsers that started to be used so we could search the web. But it was all, in Web 1, it was all one way, right? We could just read pages, we could look at ads, things like that. Web 2 was where it went two ways. It got interactive, right? We have social media is the big, and blogs, things like that, creative things. YouTube, where we were creating videos, creating blogs where we write. So Web 2 was where we would create the content, but we didn't own that content. We weren't able to monetize that content, right? That's what NFTs allow us to do now, and that's what Web 3 does. It is a new iteration of the web where we get away from some of the pernicious effects of the advertising model, where you have clickbait and trying to drive people with sensationalist articles and misinformation just to get some advertising dollars. In Web 3, you aren't monetized based on your personal information. I always say that when you're on Facebook or you're on anything like that, or even Gmail and things, when you put in a term, that goes into their search, they bid, and they send you ads based on what you were writing about. And you've seen those kind of things. It's crazy, right? And it feels uncomfortable and creepy because they're peering in on your personal information. And in Web 3, you don't monetize in that way because it's basically, when you're on, say, Facebook or something, you're not the consumer, you're not the customer, you're the product. And so that's what Web 3 gets away from. And we'll talk about that in more detail too. And DAOs, decentralized autonomous organizations, is a new way to think about governance and organizing on the blockchain. And so it's a way, corporations were the big innovation in the 20th century, the late 19th century, for creating an organization that could act in perpetuity. It was governance by plurality, basically, where you have a board of directors that and you have shareholders that are owners that are separate from the people that are actually operating in the company. That was the big innovation. And we have the stock market thing where you could trade that ownership. Those two things, the stock market and corporations, turbocharged the economic growth and development during the 20th century. Distributed autonomous organizations are the next evolution of organization and governance. So how you can do projects, how you can create governments, all kinds of things. So we'll talk about those in detail too. So these are basically the applications that are riding on the blockchain, and a lot of them are driven by incentives that are created by cryptocurrencies and what they call tokens in these environments. So the next thing I'm going to do is go through a little bit of history so we can start thinking about why these concepts are not that strange. We tend to think that the way the monetary system is set up now is that's like a law of nature. That's like a physical law. It can never change. Money is from the government, and this is how you use it, and all these kind of things. Where these are monetary devices, monies that are not created by governments. That's the real revolution here. But we can see how our concepts are, in a context, are just agreements among ourselves and actually can be changed. And so what I want to do is go through the history of money, economics a little bit, and banking and all those kind of concepts to see how we got here, and also to see why some of those concepts aren't as set in stone as we may think. So get ready. That's what we'll do next.